What do you tell buyers out there, potential buyers, about how they can position themselves
Hmm.
to get a better mortgage rate?
Sure. That's a good question. The main thing is to focus on credit history. Credit history is the most important thing, and I'll give you a couple tidbits on that.
Okay.
Typically, you want to carry anywhere from 3 to 4 major credit cards, and you really don't want to go beyond that
Okay.
because the more credit you have, logically, the more opportunity you have to get yourself in trouble.
Yeah, well, of course.
So, if you have Neiman Marcus and Nordstrom's and Macy's and all that, that's more opportunity to get in trouble.
So let me
So,
ask you, so
yes.
for because a lot of us have multiple credit cards. You go into a store and you're making a big purchase, and they say, if you would just
Yes.
open a credit card, we'll knock 20 or 30% off of this purchase. And so people will not even use the credit card.
Mhm.
If they have more than three or four, what is your advice? Do they shut those down? Because I've heard that can be detrimental to your credit.
That can be detrimental. You're right. In that particular case, if that's like a major chain store, and I understand wanting to get that 10 or 20% down because when you're making a major purchase, that's a big deal. So with that particular credit card, typically like a Best Buy or I don't know who else we could use, but an appliance situation, and you get that discount, my recommendation would be to leave the credit card open until they shut it down for you because they will shut it down.
Okay.
Yeah,
After
because
such non-use.
if there's not any activity,
Okay.
so that's going to be the best thing. But that's a very good point that you don't want to be shutting down accounts that you already have open
Okay.
because they're looking at history. That history goes towards your credit score, and the longer you have history, the better your credit score.
Okay.
So, and the other thing is to not allow your balance. If you have, for example, you have a Visa, MasterCard, something like that, where you have a $10,000 credit limit. Ideally, you do not want to allow the balance to go any higher than 3 to 5,000, which is 30 to 50%.
Okay.
Okay, because that's called your credit utilization percentage, and you don't want that percentage to increase above 30 to 50%.
And so I'm terrible. I'll put things on a credit card
Mm-hmm.
to earn points,
Mm-hmm.
and
I understand.
then I'll pay it off.
Right.
And so it sounds like I need to, just be cognizant that I need to
Yes.
keep it below a certain range in order so that it doesn't impact my credit score.
Exactly. Exactly.
That's good
Absolutely.
advice. What about?
Oh, can I make one other?
Yeah, please.
On that subject about credit and how credit is so important. When I purchased my house back in the 90s, I put 5% down, as I mentioned, which means that I had to have mortgage insurance. Well, the mortgage insurance premium that I paid monthly was a one size fits all. I got no benefit from the fact that I had good credit history at that time. I paid the same that somebody with less than perfect credit would have paid,
Right.
as long as I was approved for my loan. But today, the good news is that everything is risk-based priced. That comes down to the interest rate, and that even comes down to the mortgage insurance premium. So if you have very strong credit, you're going to get that good interest rate. And if you put down less than 20%, you're going to have mortgage insurance, but you're going to pay much less, which is very good.
That's great.
It's amazing the difference. I would venture to say, off the top of my head, for say a $300,000 loan, we're talking about a difference of maybe $100 to $150 a month that you could save.
Okay. That's great.
So that's a big deal, big
Very good.
positive. Mhm.
John, what tricks do you have up your sleeve
Mhm.
that buyers and or sellers could utilize to sort of get around these high rates right now?
That's a
You
good
know what
question.
I mean by
Yes, absolutely.
that? Strategies.
So there's an opportunity from the seller to get, instead of a contribution or assistance towards your closing costs, to ask, and this is happening in some cases where the seller's trying to market their house, they'll buy down that interest rate for you for the first 2 or sometimes even 3 years.
Okay.
And what happens in that case, the reason that it's called a 2-1 buy down is because for the first year, it's that rate is purchased down by 2%. The second year, it's bought down by 1%. And then you go to your 30-year fixed rate that remains for the rest of the
Okay.
loan. That's one way to get a leg up on the interest rate situation.
Okay.
Also, another one that should be coming into play is going to be an adjustable rate. I know that strikes fear with a lot of people because they don't like that fluctuation.
Right.
But the adjustable rates in the mortgage world are fixed for the first 5 to 7 years.
Okay.
In some cases 3, but most of the time they do 5, 7, and 10 years.
So it's really the same as an arm, right? Is
Yes,
that correct? Okay.
exactly. Yep. And so that first 5, 7, and 10 years, depending on which of those adjustable rates that you get, that rate is not going to move.
Okay.
That should give you more than ample time to get a refinance into a fixed rate.
Perfect.
So,
I wanted to ask you, John, about first and seconds
Sure.
because we used to see those come into play a little bit. And are they coming back?
so there is a little bit more interest in those, but the main idea behind the first and the second lien initially when they came out was to avoid the mortgage insurance.
Okay.
But because of the risk-based pricing these days, if you have good credit, you're rewarded with a much lower mortgage insurance premium. And because of that, the second lien mortgages may not be as attractive. It's going to be a case-by-case situation
Okay.
where with our clients, what we do is we'll show them a side-by-side comparison so that we can make the best decision for them. The second liens are typically based on a 15-year note.
Okay.
And so there's the opportunity to build equity a little bit faster. But so we have to go in and analyze those numbers to see if it's more advantageous to do the mortgage insurance or if it's better to do the second lien.
Got it.
So everybody has different goals and what they're trying to achieve. And if they're trying to achieve that equity building situation, even if the mortgage payment with the first and the second lien ends up being a little bit higher, they may decide to go that route. So that would be probably my advice in this environment to look at a second lien,
Okay.
is because of the opportunity to build that equity quicker.
And I'm guessing that's something that you do for your clients. You look at this is how much you're wanting to finance, and these are all of the ways that we can go about it and helping them pick the most advantageous one.
Absolutely. We actually use a program in the industry where it allows us to put 4 different scenarios in a presentation, and we actually do a video. That's why I'm a little bit more comfortable with the camera. No. But anyways, hey, it's a cut up. So we like to put together those presentations because, most everybody thinks of the straightforward 30-year fixed mortgage,
Right.
20% down, that kind of thing. And we like to show different scenarios to say, look, have you thought about this? Because
Right.
this may be more advantageous for you. If you're trying to save for your kids' college or something like that, there may be different ways of financing that make more sense for you.
That's great. Very beneficial.
Yes.
So when I have a buyer who's coming to me that doesn't have a lender, I will recommend to them that they get a local lender.
Great idea.
Not just a Texas lender, which is very important, but also one that is here locally.
Sure.
Can you explain why that is a priority?
Absolutely. Just like everything, in my opinion, local is usually a little bit better. But in this particular case, just like you being here as a real estate agent and working with your clients in this area, your knowledge is vast for this area.
Correct.
Okay. If you were to sell a house in Washington, it might be a little bit different.
I know nothing
You
about
wouldn't know-
Washington.
You wouldn't know
Correct.
anything about Washington. So it's very similar when it comes to the lending environment. We know a lot of the appraisers in the area. We know, what is traditional or what helps a client from a financing standpoint. Just those things, just knowing the local market is extremely important, and it helps to get the loan done quicker because we've worked in this environment. We know, for example, we know the different taxing authorities, we know the different homeowners associations. We can help recommend different insurance opportunities because insurance in Texas can be kind of a crazy market.
Right.
It can be, you can have very high priced policies, you can have very low price policies. What's the advantage of both of those? So we know those kind of things, and so I think local is best.
It's critical.
That knowledge.
Yeah, critical. Paying an extra mortgage payment
Oh
a
yeah,
year.
love that. That's magic.
We've heard of that, right?
That is
Talk
magic.
to the viewers
Mhm.
about, whether they should do that or not, and why, and what value that might create.
I always love that question. And what I'm going to discuss is based on a 30-year mortgage, which is very traditional. And a lot of times I will say that we recommend the 30-year mortgage, and we do that because you're obligated to a lower monthly payment
Okay.
than you would be if you were on a 15-year fixed.
Okay.
So we always recommend that to begin with. But if you make one extra mortgage payment per year,
Just
you,
one.
just one, you will take a 30-year note and turn it into a 23 to 24 year payoff.
That's amazing.
It is absolutely amazing. And I'm not talking about if you escrow your taxes and your insurance, because if you have a $1,200 mortgage payment and you add on to that $800 more to make it $2,000 for the taxes and the insurance, I'm not talking about one full $2,000 payment per year. I'm
Really?
talking
You're
about
just
the
talking about
$1,200.
principal?
Just the $1,200. That's
Wow.
it.
Okay.
Yeah.
And so, and when you say that,
Mhm.
do I have to hold back and come up with this lump sum at once, or could I just add a bit to each of the 12 payments every
Whatever
year?
is your preference.
Okay.
If you prefer to take that $1,200 and divide it by 12 and make $100 extra per month,
Right?
then do the $100 extra per month. If you're the type that has a good savings and you just want to do a lump sum of $1,200 at the end of the year, absolutely accomplish the same thing.
Wow.
And you take it and make it a 23 to 24 year note,
That's great.
which is amazing. It's amazing when you think about on the worst case scenario, if you think about it becoming a 24-year note, and you multiply the remaining years, 6 years,
Yes.
which is 72 months, by $1,200, that's a lot of savings.
That is a lot of savings.
And it's all interest that you would have paid.
Wow.
Mhm.
While we're winding up here, if there was one or two things that you would want the viewer and buyers to know that we haven't really talked about today,
Mhm.
what would something like that be?
Well,
What have we missed?
I can't come up with anything maybe that we missed, except that I cannot harp enough on timing now. Just don't worry about interest rates. The fact is that interest rates are going to fluctuate just like your stock market, just like home prices, just like food prices. Everything is going to fluctuate. Rates are going to fluctuate too. So that means that there's going to be an opportunity in the future to refinance. I will go out on the limb and say that we feel in our industry that it's going to be 12 to 24 months from now
Okay.
that you'll have an opportunity to refinance. And because of that, I would not wait for 12 to 24 months, because that may not actually come to fruition, but I'm confident it will.
Okay.
But if it didn't, for some reason, if it got extended out to 24 to 36 months, you would have missed out on those 2 or 3 years of building equity for yourself in your home. Because when you make a payment, I know that some of it goes towards interest, and a lot of people look at that number and they're like, oh my gosh, that's a lot of interest. It is. Well, but you're borrowing money, right?
Right.
But some of it goes towards principal, and that amount that goes towards principal is yours. That is your money. Even though, you take it from this wallet or this purse and you move it over to this wallet or this purse.
Right.
And so it's still yours. And that's why I think it's imperative to buy real estate. It helps to build that wealth. no matter
Great
your age.
information, John. Jon Sanderson with me today with Supreme Lending. Don't hesitate to reach out and let him and his expertise work for you. Thanks for joining us.
Thank you for the opportunity.
Thanks, John.